In November 2022, the third largest cryptocurrency exchange in the world collapsed in 48 hours. $8 billion in customer deposits vanished. The man who had been on the cover of Forbes, Fortune, and Time, hailed as the next Warren Buffett, was arrested in the Bahamas. His name was Sam Bankman-Fried. To the public, he was a billionaire philanthropist giving away his fortune. Behind the scenes, he was running a shell game with other people's money. FTX launched in 2019 with a seductive pitch, a crypto exchange built by traders for traders, low fees, deep liquidity, a matching engine that could handle millions of orders per second. Sam Bankman-Fried, a 26-year-old MIT physics grad from Stanford, presented himself as the adult in the room. He wore rumpled shorts and a bean-bag chair for a desk. He drove a Corolla. He said he wanted to give away his entire fortune. The effective altruism movement embraced him. Venture capitalists fought to invest. Sequoia, SoftBank, Temasek, the Ontario Teachers' Pension Plan. By January 2022, FTX was valued at $32 billion. Sam Bankman-Fried grew up in Stanford's orbit. Both parents were law professors. He studied physics at MIT, interned at Jane Street Capital, a quantitative trading firm. There he learned to exploit tiny price discrepancies across markets, high-frequency trading at scale. In 2017, he founded Alameda Research, a crypto trading firm. 2 years later, he spun up FTX to solve a problem he knew well. Crypto exchanges were unreliable, slow, and often insolvent. His co-founder, Gary Wang, had been his college roommate. Caroline Ellison, a former Jane Street trader, became CEO of Alameda. The inner circle was small, loyal, and entirely in Sam's control. FTX grew at a speed that defied precedent. Super Bowl commercials with Larry David, stadium naming rights in Miami, Tom Brady and Gisele Bündchen as brand ambassadors, Stephen Curry, Naomi Osaka, Shohei Ohtani. The marketing machine spent hundreds of millions, but the real engine was the FTT token, FTX's native cryptocurrency. Alameda Research held billions in FTT on its balance sheet. FTX printed the token, Alameda used it as collateral, and the rising price funded more growth. A circular machine. As long as new money flowed in, the valuations held. By 2021, FTX processed $10 billion in daily volume. Sam Bankman-Fried testified before Congress. He dated the daughter of a senior SEC official. He donated $40 million to political campaigns. He was the face of crypto's legitimacy. The mechanism was hidden in plain sight. FTX's terms of service allowed the exchange to use customer funds. Alameda Research had a secret backdoor, a line of credit with no liquidation threshold, no margin calls, no collateral requirements. When customers deposited dollars or Bitcoin, FTX credited their accounts, but the assets were commingled. Alameda borrowed freely from the exchange's coffers to fund venture investments, political donations, real estate in the Bahamas, and losing trades. The liabilities grew. By late 2022, Alameda owed FTX roughly $10 billion. $8 billion of that belonged to customers. The hole was plugged with fictional accounting, and the FTT token's inflated price. A house of cards built on its own currency. The crack appeared on November 2, 2022. CoinDesk published Alameda's balance sheet. $14 billion in assets, $8 billion in liabilities. The largest asset, $5 billion in FTT, a token created by FTX held by its sister company. The crypto community understood immediately. If FTT crashed, Alameda was insolvent. And if Alameda was insolvent, FTX customer funds were gone. Changpeng Zhao, CEO of Binance and an early FTX investor, announced he would sell his FTT holdings. The market panicked. FTT plummeted. Customers rushed to withdraw. FTX froze withdrawals. On November 11, FTX filed for Chapter 11 bankruptcy. Sam Bankman-Fried resigned. The Bahamas seized his assets. The $32 billion valuation was revealed as a fiction. Behind every number was a person. A teacher in Venezuela who lost her life savings. A student in Nigeria who put his tuition on the exchange. A retiree in the UK who trusted the Super Bowl ad. Over 1 million creditors. $8 billion in missing customer funds. The new CEO, John Ray III, the same liquidator who unwound Enron, called it the worst corporate governance failure he had ever seen. "Never in my career have I seen such a complete failure of corporate controls," he told Congress. Employees who had believed in the mission found their own savings locked on the platform. Investors who had done due diligence faced total write-offs. The effective altruism movement, which had received hundreds of millions in pledged donations, faced a crisis of credibility. The investigations moved fast. The Department of Justice, the SEC, the CFTC, the Southern District of New York, Caroline Ellison and Gary Wang pleaded guilty in December 2022. They agreed to cooperate. The trial began in October 2023. The evidence was overwhelming. Spreadsheets showing the allow negative balance setting for Alameda. Signal messages where Sam directed the movement of funds. Testimony that he knew the risks, knew the commingling, chose to continue. On November 2, 2023, the jury convicted Sam Bankman-Fried on all 7 counts: wire fraud, securities fraud, commodities fraud, money laundering, and conspiracy. He faced up to 115 years. On March 28, 2024, Judge Lewis Kaplan sentenced him to 25 years in federal prison. The judge said, "He knew it was wrong. He knew it was criminal. He did it anyway." FTX was not a technology failure. It was a human failure, a failure of oversight, of greed, of the willingness to believe a story because the storyteller looked the part. The venture capitalists who skipped due diligence, the regulators who moved too slowly, the media that amplified the myth, the customers who trusted a brand over a balance sheet. Crypto promised to remove trust. FTX proved that without trust, without transparency, without consequences, the system eats itself. Sam Bankman-Fried will spend decades in prison. The customers may never recover their money. The lesson is not that crypto is broken. The lesson is that the oldest fraud in history, stealing from the till, works just as well in a hoodie as it does in a suit. The story must survive reality. This one didn't.